Hello, everyone. Imagine waking up one morning in 2026, grabbing your phone to check the news, and suddenly seeing the US dollar in freefall against the euro and yuan. Gas prices have jumped overnight from $5 to $12 per gallon. Bread and milk have doubled in price, and supermarkets have long lines as people panic, buy everything in sight. Banks have imposed cash withdrawal limits, Wall Street has plunged over 40%, and in some cities, protests are turning into looting. Now imagine this is just the beginning. Food shortages lead to local clashes, states start controlling their own borders, and rumors of political secession spread. This isn't just a nightmare. It could be the realistic scenario of a US dollar collapse in 2026, a chain of events that might spiral into widespread unrest, social chaos, and even something resembling Civil War 2.0, not with organized armies, but with local militias, guerrilla warfare, and regional fragmentation. I'm a political economic analyst, and today I'm going to lay out a fully realistic, detailed scenario based on trends that are happening right now. We'll go deep: the economic background, the role of specific countries, step-by-step social impacts, global reactions, and even potential paths to recovery. Everything is grounded in real data from sources like the U.S. Treasury, BRICS developments, and current Trump administration policies. If you're ready for a gripping but sobering ride, let's dive in. And remember, this scenario is possible, but it can still be prevented. Let's start with the real background: why 2026 could be the tipping point. By the end of 2025, U.S. national debt has reached approximately $38.4 trillion, over $115,000 in debt per American citizen, from newborns to seniors. This debt comes largely from persistent budget deficits, high military spending, over $800 billion annually, growing social programs like Medicare and Social Security strained by an aging population, and now Trump's second-term policies, including corporate tax cuts to 15% and increased infrastructure spending. Interest payments on the debt have surpassed $1 trillion annually, $970 billion in fiscal 2025 alone, according to the Committee for a Responsible Federal Budget, eating into the budget so much that debt service now exceeds defense or education spending. In Trump's second term, broad tariffs have been implemented: 10 to 60% on imports from China, electronics, steel, 25% on vehicles and parts from Mexico and Canada, and threats of 100% on branded drugs unless companies relocate production to the U.S. The goal was to boost domestic manufacturing and reduce the trade deficit, around $1 trillion in 2025. But in practice, they've raised costs for American companies, disrupted global supply chains, and fueled inflation. Companies like Apple and Tesla, reliant on Chinese parts, have passed higher costs to consumers. Economists like Peter Schiff and CRFB analysts have warned that these policies slowed GDP growth from 2.5% to under 1.5%. At the same time, BRICS nations, Brazil, Russia, India, China, South Africa, plus new members Saudi Arabia, UAE, Egypt, Ethiopia, Iran, and Indonesia, officially joined January 2025, are rapidly reducing dollar dependence. BRICS now represents over 40% of the world's population and 30% of global GDP. Bilateral trade in local currencies has grown over 30%. China and Saudi Arabia trade oil in yuan. Russia and India settle gas in rupees. Central banks set gold buying records, over 1,100 tons in 2024 alone, and alternative payment systems like M-Bridge, BRICS blockchain platform, and China's CIPES are expanding. Trump has threatened 100% tariffs if BRICS launches a common currency, but these threats have only accelerated de-dollarization. India and Brazil now conduct over 50% of their BRICS trade without dollars. Now let's step into 2026 and walk through the scenario month by month. Early January. To avert a looming recession, growth already slowed in 2025, the Federal Reserve is forced to slash interest rates dramatically, from around 4% to below 2% in an emergency meeting. This spooks foreign investors. China, holding over $1 trillion in U.S. treasuries, begins quietly selling dollars and converting to yuan, euro, or gold. Japan, the second largest holder, $1.1 trillion, follows suit to support its own economy. Saudi Arabia, influenced by BRICS, signs new contracts with China for yuan-denominated oil sales and gradually shifts away from the dollar. The dollar index, DXY, around 98 at the end of 2025, drops below 80 in the first quarter, a 20% plus loss in value, faster than the 2008 crisis. Now, let's step into 2026 and walk through the scenario month by month. Early January. To avert a looming recession, growth already slowed in 2025, the Federal Reserve is forced to slash interest rates dramatically, from around 4% to below 2% in an emergency meeting. This spooks foreign investors. China, holding over $1 trillion in U.S. treasuries, begins quietly selling dollars and converting to yuan, euro, or gold. Japan, the second largest holder, $1.1 trillion, follows suit to support its own economy. Saudi Arabia, influenced by BRICS, signs new contracts with China for yuan-denominated oil sales and gradually shifts away from the dollar. The dollar index, DXY, around 98 at the end of 2025, drops below 80 in the first quarter, a 20% plus loss in value, faster than the 2008 crisis. Spring 2026. The real effects hit. Since the U.S. imports over 70% of its consumer goods, from clothing and electronics to fruit and medicine, a weaker dollar makes imports skyrocket in price. Gasoline reaches $10 to $15 per gallon as crude oil trades in stronger currencies like yuan. Staple foods, wheat, corn, soy, much imported from Canada, Brazil, Argentina, jump 60 to 100%. A typical American family that spent $500 monthly on groceries now needs $1,000. Official inflation surges from 4 to 5% the prior year to 25 to 30% annually. Controlled hyperinflation reminiscent of Argentina or Turkey, but in the world's largest economy. Major retailers like Walmart and Amazon raise prices, demand collapses, and mass layoffs begin. Amazon cuts 50,000 jobs, Apple scales back production. Unemployment rises from 4% to 12 to 15%, hitting Rust Belt cities like Detroit and Cleveland hardest. Wall Street enters a deep bear market. The S&P 500 falls over 50%, wiping out trillions in paper wealth. Apple stock drops from $200 to under $100. Retirement funds like 401ks take massive hits, leaving millions seeing their savings halved. People rush banks for cash, but FDIC insurance covers only $250,000 per account, and banks impose daily limits, $500 or $1,000. Bank-run rumors spread on platforms like X and Facebook, forming long ATM lines worse than 2008. The Trump administration responds: new stimulus packages, $2,000 checks per family, fuel subsidies to keep gas under $10, and price controls on essentials. But funding requires more money printing. The Fed launches new QE, which worsens inflation. Congress remains gridlocked. Republicans push for higher tariffs, Democrats for debt restructuring. Protests erupt in major blue cities, New York, Chicago, Los Angeles, against soaring costs and unemployment, with chants like, "The dollar is dead, keep America alive." The deep political divide, exacerbated since the 2024 election, quickly turns protests partisan. Trump supporters blame sleepy Democrats and a Chinese plot. Opponents point to Trump's tariffs and isolationism. Outlets like Fox News and MSNBC amplify the divide. Summer 2026. Real shortages emerge. Global supply chains, already strained by tariffs, falter. Fewer container ships arrive from China. Store shelves empty. Sporadic looting breaks out in cities like Oakland, Portland, and Atlanta. Red states like Texas, Florida, and Oklahoma, with strong energy and agriculture, fare better. Governors take independent action. Border checkpoints to block economic migrants from harder-hit states, or restricting food exports to prioritize locals. Local militias activate, some for neighborhood protection, prepper groups in Texas, others politically motivated, e.g., emboldened Proud Boys. Blue states like California and New York effectively defy federal orders, imposing emergency taxes to aid the unemployed, accepting foreign aid from Canada, food, and Mexico, energy. Sporadic armed clashes begin. Shootings at protests, 10 dead in a Chicago rally, attacks on federal buildings, bombing of a federal office in Los Angeles, localized blackouts by saboteurs. The U.S. military, the country's largest employer, faces budget shortfalls, delayed paychecks, and some units pledge loyalty to home states over Washington. This isn't a classic civil war with clear front lines. It's widespread chaos, urban guerrilla warfare, drones, personal firearms, and regional secession. Texas could declare de facto economic independence with a local currency, Texas dollar. California might form a Pacific alliance with Oregon and Washington for Asian trade, and the Midwest becomes a zone of ethnic and political conflict. Millions become internally displaced. Around 10 million flee cities for rural areas. The real economy grinds to a halt, factories close, and U.S. GDP in 2026 could fall 30 to 50%. Worse than the 1930s Great Depression, dropping below $20 trillion. Globally, the dollar collapse sends shockwaves. Export-dependent economies, China, 15% of exports to U.S., Mexico, Germany, enter deep recessions. China's growth dips below 3%. But China capitalizes, strengthening the yuan as a reserve alternative and expanding BRICS trade. BRICS launches its common payment system. Over 40% of global oil trade shifts to non-dollar currencies. Russia sells to India in rubles. Russia intensifies pressure on Ukraine as U.S. aid dries up, no more $100 billion packages. China escalates maneuvers near Taiwan. U.S. sanctions lose teeth without dollar dominance. Iran and Venezuela shrug them off. Europe grapples with energy crises and inflation. Germany's GDP falls 5%, but the euro holds relatively strong, and the EU pivots toward BRICS trade. Developing nations like India and Brazil shift to gold and local currencies. Africa gains opportunities via BRICS members like Ethiopia. The world moves toward a multipolar financial system where the dollar is just one player among yuan, euro, rupee, and gold. By year-end 2026, America is fractured. Semi-autonomous regions, Republic of Texas, Western Union, inflation moderated to 15% via controls, and an economy that will take years to recover. A new government or revised federal structure may emerge, more power to states, but public trust is permanently damaged. Millions are poorer, inequality has soared, and reverse migration to Canada or Europe has begun. This scenario sounds extreme, but every step is built on real trends: unsustainable debt, disruptive tariffs, gradual de-dollarization, and deep social divisions. 2025 Pew Research shows 70% of Americans believe the country is on the wrong track. Fortunately, prevention is still possible. Through fiscal reforms like higher taxes on the wealthy, bipartisan dialogue to reduce political tension, and international cooperation with BRICS for financial stability. If acted on, 2026 could be a year of recovery, not collapse. What do you think? Is the dollar truly at risk of total collapse? Can America avoid a second civil war, or is this scenario too close to reality? Drop your thoughts in the comments, like the video, and subscribe so you don't miss the next scenarios. Thanks for sticking with me to the end.